You can create substantial wealth without a high salary by managing your spending, risk, and costs effectively. Most individuals lose money due to poor habits, excessive fees, and emotional choices, rather than from market downturns. This strategy emphasizes what you can control and utilizes broad index funds for investing. You don't need complicated products, market predictions, or constant trading to achieve financial independence. A clear savings rate, a solid plan for debt, and a comprehensible portfolio are essential for success. The 9 rules outlined in this guide connect spending discipline with basic investing principles and behavior during market fluctuations. By integrating these elements, you can outperform many professionals who attempt to predict market movements. In the upcoming sections, we'll dive into spending management, the power of compounding, understanding fees, discipline, portfolio design, and seeking reliable guidance. For an in-depth framework, refer to Millionaire Teacher by Andrew Hallam, which provides detailed insights and data. Subscribe for more videos that simplify investing into clear, actionable routines you can easily follow. The first rule is straightforward. Refrain from making purchases that jeopardize your future savings and investments. Building wealth hinges on acquiring assets that appreciate rather than accumulating debts that drain your finances monthly. Track all your expenses for a month to identify spending patterns instead of speculating. Determine which expenses align with your goals and eliminate the rest without guilt. Significant recurring expenses such as housing and transportation are more impactful than minor indulgences because they create lasting financial commitments. Use the difference between your income and expenses to establish an emergency fund, and thereafter, invest consistently. If you have high-interest consumer debt, prioritize paying it off before taking on additional market risks. Treat saving as a mandatory expense you owe to yourself, rather than as a leftover after spending. Automating your savings and investments can eliminate daily choices and safeguard your plan against impulse buying. Once your spending stops being detrimental, applying each subsequent investing rule becomes far more manageable. Time is more critical than perfect investment selection, as compounding can transform a modest starting amount into a substantial sum. Compounding means you reinvest your gains, allowing future earnings to build on past profits. Start investing as early as possible, even with small amounts, and increase your contributions as your income grows. A simple method to get started is to transfer funds into your savings and investment accounts each payday. Investing in stocks signifies ownership in companies, and your returns stem from their profits and reinvestment strategies. Markets experience fluctuations, so aim to stay invested long enough to capture growth over time. Regular investing helps average your purchase costs, minimizing the impact of unfortunate timing. Keep your investment plan uncomplicated, as complexity can introduce unnecessary decisions, often leading to errors. Developing the habit of saving and investing is far more crucial than finding the perfect account or fund. When you begin early, the 2 main threats to your financial progress are costs and behavioral biases. Although fees may seem small on paper, they can significantly erode tens of thousands of dollars throughout your lifetime. Many investors opt for actively managed mutual funds, despite most of them failing to outperform simple index funds. Previous standout performers do not guarantee future success, so chasing after rankings often leads to disappointment and increased taxes. Index funds typically comprise a wide array of stocks, trade less frequently, and incur much lower operational costs. By minimizing turnover, you can also lower your tax burden in taxable accounts, allowing more of your returns to stay in your pocket. Before investing in any fund, examine the expense ratio, any trading costs involved, and the fund's trading frequency. While low-cost funds don't guarantee profits, high-cost ones assure a lower return than the market average. If you engage an advisor or a platform, clarify how they are compensated and what incentives they may have. Your investment plan should succeed without relying on lucky guesses, as fees and taxes can be anticipated and managed. Subscribe for more insights on creating a straightforward, low-cost investing strategy that remains effective. Most investment errors occur when emotions disrupt your strategy, especially in volatile market conditions. Attempting to time the market typically results in selling after declines and buying after prices have already risen. Missing just a few of the market's best performing days can dramatically impact your long-term returns. Establish specific rules for adding capital, rebalancing your portfolio, and knowing when to maintain the status quo. A written plan decreases uncertainty by providing a step-by-step approach rather than reacting impulsively to news headlines. If stock prices rise faster than bonds, rebalancing your portfolio means reallocating funds back into bonds to maintain your target allocation. Conversely, if stock prices decline, rebalancing provides an opportunity to buy more stocks at discounted prices. This disciplined approach transforms market fluctuations into routine decisions rather than crises that threaten your identity. While you can't control economic conditions, you can manage your reactions, contributions, and the rules guiding your portfolio. Stability in your behavior over time allows your investment strategy to function effectively over the long haul. A well-structured portfolio aligns your growth objectives with your capacity to handle risk. Stocks offer potential for higher long-term returns, but they also come with the risk of steep declines over extended periods. Bonds represent loans made to governments or corporations, and they generally exhibit lower volatility compared to stocks. Combining stocks and bonds can help stabilize your investment outcomes, making it less likely that you abandon your strategy. Choose your mix of stocks and bonds based on your investment horizon and your emotional response to market downturns. A simple index portfolio can consist of a total stock market allocation and high-quality bonds, all while keeping costs minimal. Rebalance your portfolio on a regular schedule, ideally once or twice a year, instead of tracking prices daily. This approach minimizes trading activity, lowers your tax burden, and ensures that you adhere to your desired risk level. You can achieve this through mutual fund index funds or exchange-traded funds, depending on the associated costs. The goal is not to have a wide variety of investments, but rather to ensure a diversified portfolio that spans across the globe while remaining manageable. You can handle your investments independently, but there's no need to navigate every step alone. Many individuals opt for robo-advisors that create diversified index portfolios and manage rebalancing automatically. Alternatively, you might choose to hire financial advisors. However, it's essential to fully understand any potential conflicts of interest, fees and sales incentives before committing. Beware of high-fee products that often come with complicated language. Always request a clear breakdown of total costs in dollars. Approach strategies based on backtests with caution, as past performance does not guarantee future results. Be aware that smart beta funds may carry higher costs compared to standard index funds, even if their marketing suggests scientific backing. Currency hedging can introduce additional costs and complexity. Some studies indicate that it might even hinder returns. The safest investment strategy focuses on consistently saving, keeping fees low, diversifying broadly, and adhering to the same principles over time. Once you grasp the basics and commit to the method, investing can become a straightforward and repeatable process. Don't forget to subscribe for more valuable insights that guide you in wealth building through clear, actionable steps and fewer costly errors.